I see that our guest has joined us, and I'd like to take a moment to introduce Peter Callister from venturecapital.org. Peter, I think I can pin you so they all get to see your bright smile face amongst a sea of other faces for a moment. I don't know how many of you are familiar with venturecapital.org, but it's a very important firm to the venture capital space, certainly in the region, and I would say nationally. Peter is the Chief Operating Officer of venturecapital.org and has agreed to take some time with us today. So Peter, thank you for doing so, and we're looking forward to visiting with you.
Well, thank you for having me. Well, this is fun. So in addition to working for venturecapital.org, I'm also a Westminster alumnus. I graduated in 2007, so it's been a little while. Thank you for having me. So venturecapital.org we're not a VC, we're a nonprofit, and we assist entrepreneurs in telling their story to investors in a compelling fashion. We'll dig into that a little bit later, but I'm excited to visit with you on early stage private equity. Can everybody see my screen?
Yes.
Okay. So the way that I present, I go fast. If you have questions, feel free to interrupt me because we're going to be going over quite a bit of content over the next few minutes.
So the full cycle of capital for startups begins with friends and family rounds and team investment, entrepreneurs, founders investing themselves, moving on to angel investors, accelerators may or may not play a role, ultimately ending in an IPO. Most companies typically don't get there to an IPO. They get acquired along the way, either by another startup or a company in industry or a private equity firm. We'll focus today on kind of the earliest stages going from friends and family to venture capital. And I don't know if you heard me before, but feel free to interrupt me as you have questions, and we can drill down a little bit deeper. And so who gets funded? And so the majority of angel and venture capital goes to IT companies. IT companies tend to have lower capital needs and exit more quickly than other startups. When you're not creating a physical product or a service, it's a little bit easier to pivot when you're just writing code. Friends and family will tend to fund development as opposed to growth. The later startups go in the process, the more that they will use capital almost exclusively for growth. One of the target milestones for each round of financing is to increase company value by 3 to 5 times. And typically, as companies go down the path, and every company is different, but they'll raise around every year or two. Investment into life science startups has been decreasing over the last 20 years due to the large amount of capital required to go through the FDA and ultimately going to the market. Angels, friends and family really don't do anything with pharmaceuticals just because it's so capital intensive. The exception tends to be medical device startups, particularly those that can fast track approval through the FDA 510K rules are an exception. Those tend to go a little bit faster and get acquired a little bit easier. 510K rules are where a medical device can use a predicate device that's already been approved by the FDA. There's an approval process and consequently reduce the time that is needed to go through FDA approval. The balance of companies go through, the balance of capital goes to a broad array of companies, including consumer products, which make up 5 to 10% depending on the year, clean tech, and other niche industries. And so friends and family round typically happens at the earliest stages of the startup stage. Companies may be a concept only, maybe a little bit more than that. The company may or may not have customers, may or may not have a product or service fully designed or ready to market, but generally has some type of roadmap of where they're going. Investors at the stage tend to not be sophisticated, and oftentimes the founders are similar. Most entrepreneurs are first-timers, 98%. This can be pretty dangerous for an early-stage company as transactions with weird deal terms can be problematic for future rounds of funding. And it's really a function of just not having the experience or not knowing better. And so examples can include giving too much equity away, creating a bad board or oversight structures, or implementing weird repayment terms, or offering undilutable equity. Deal terms can always be reworked, but it can be difficult once you take money from someone, it's very much like getting married, but it's a lot more difficult to get divorced. And so I've experienced with a handful of companies that have a great product, have a great service, that took on an investor pretty early on that wanted an outrageous interest rate, and it can be really difficult to get those out of your deal. And so just at every stage of raising capital, you can run into the same issue, whether it's friends and family or with an angel or even a VC. Angel investors are accredited investors, meaning that they have either more than $1 million in assets, not including their home, or $200,000 in annual income over the last 2 years, or $300,000 if they're married. The thinking behind this is if people are financially well off, they're better suited to take on some of these risks without going through SEC rules or SEC filings. Angel investors are often wealthy, and they operate on their own or within a group. Some are very active with their investments, and some are extraordinarily passive. There was a deal that I was a part of where the investor that was the most outspoken was had the least investment in the company, and those who had invested a multiple of what he had never really contacted us after we put the deal together, which is kind of strange. Some angel investors have industry experience, which are the best. They can help a startup beyond their dollars to grow by making connections and helping the founding team understand what they don't know. Angel investors often work with groups to source and fund companies. And so some examples include the Park City Angels, the Salt Lake City Angels, UA2, which is the Utah Angels 2. Prior to, I would say, 10 years ago, most of their investments tend to be priced, and that's become a lot less frequent. Traditionally, prior to that, valuations tended to be between $750,000, $100,000, and $5 million is really the cap. The biggest angel deal that I've seen locally was $2 million, and that was a syndicate of 3 angel groups putting that together. They typically look for investments over a 3 to 7 year horizon, although angels, because they're individuals, all have different objectives. There's not just one. Some are longer term. Others, as they're approaching end of life, that's kind of as far as they'll look to. And they target returns of 10 to 20 times their money back once the deal exits. And we'll talk a little bit more about that on the next slide. The trend over the last 10 years moved from convertible notes, which were debt instruments with a stated interest rate. The intention was not to ever exit as a note, but to convert into equity at some point in the future. It made it a lot easier to talk about valuation and to get a deal done, much less expensive. The new trend are SAFE agreements. SAFE is an acronym for Simple Agreement for Future Equity, which are a lot more straightforward, a lot less expensive than convertible notes, and you could say much more entrepreneurial friendly. With COVID, it's interesting. We've had a lot of conversations, doing a couple of webinars on this topic, but it'll be interesting to see if we see a trend moving back towards priced rounds as equity dollars available may go down overall. The other upside to SAFE agreements is if you're an angel, and SAFE agreements came out of Y Combinator, that if you wanted to invest, say, $25,000, right, or a smaller amount, it made it a lot easier to work through that process than doing a convertible note. And one of the companies that I've worked with, well, and looking at most companies, usually to do a priced round, it costs about $20,000 to $30,000 in legal fees, so it's not inconsequential. There's another group of investors, accelerators. They started popping up over the last 10 to 15 years. They tend to have been started by former entrepreneurs who are wanting to help other entrepreneurs. And so you may have heard of Y Combinator, Techstars, Boom Startup, which recently got acquired, and there are tons. They typically have cohorts that work with a company for 3 to 6 months. The cohort size varies depending on the accelerator. The startup is taken through a startup program by accelerator staff and mentors. Typically, a lot of those mentors are mentor investors. and they have functional experience in marketing, operations, development, and other key areas. They almost all use some type of lean methodology, and we can dig in that a little bit deeper if there are questions on what that is. I don't know if that's covered as part of your program. But the value proposition for the startup is the companies move forward faster, are able to iterate much more quickly. They talk about failing fast and figuring out how to pivot in order to succeed, and ultimately building new business relationships. And so most accelerators will ask for 6 to 15% equity. That some provide cash. They want the companies tend to be a little bit earlier, and they want the founding team to really focus for that period on building the business and driving towards that seed round. And so they'll give sometimes $25,000 up to $50,000 to support living expenses while participating in the program, so no one's working on it part-time with a day job. VentureCapital.org is technically an accelerator. We haven't thought about ourselves quite in that way, and we'll talk about us a little bit later in the presentation. Any questions so far? Great. So VCs, venture capitalists, are professional investors. Most have investment parameters that define the type of companies they'll invest in and how big their check sizes are. There are different types. There are some that invest in what we call Series A, which is the first kind of professional round. That can go all the way to Series G, depending on the company. Most companies don't go that far, but typically you have VCs that focus on Series A, Series B. You have those that focus on Series D, C and D, which is where most companies fall. And check sizes gradually get bigger. The smallest valuation for a VC is about $3 million, and that's even a little bit small. Pre-money valuations tend to be between $3 and $8 million and increases as the rounds go on. Most rounds are priced roughly for a 20% equity position, and it just kind of always falls out that way. I'd say the range is probably 15 to 25%. 30% would be pretty high. VCs typically raise individual funds, and so they may have their Fund 1, which tends to be a little bit on the smaller size. Kickstarter is a great example. Their first fund was $8 million back in 2006, 2007. Their next fund that they raised was $25 million, and it continued to grow bigger. I think they just closed a $40 or $50 million fund. They make money by charging a fee to the limited partners or their investors to help support annual salaries and overhead, but they also have a carried interest in the fund, and so they're rewarded along with success. And so a minimal investment for a VC would be $1 million, and that would even be on the small size. Typically, it goes up from there. They invest over a 3 to 7 year horizon. So each fund is typically designed to go for up to 10 years. And so they really want to have an exit before that period ramps up. And again, they target 10 to 20 times return on an investment. And the reason for that, most of their investments they know will fail, angels and VCs. It's not uncommon for half of a portfolio to fail, and it's just because of the risk associated with the underlying investments. All of these companies have technical risk, management risk, market risk, where it's just pretty outrageous. And so the expectation is 5 out of 10 will fail. 1 to 2 may return part or all of the money invested. 2 or 3 will provide a 2 to 3 times return, and 1 to 2 will provide 10 to 20 times return, and it ultimately pays for the portfolio. VCs typically target a 20 to 30% IRR on their investments. And there was something really early in my career. I was working to help run the Park City Angels, and I had a guy explain to me there was an old adage of that if you don't have too many deals fail, then you're not doing your job as a VC. You're not taking enough risk. And so some of the things that angels and VCs look at, they both structure deals so that if everything goes well, they'll get that 10 to 20 times return, and they price their deals that way. And they look at, if they put in capital, if they can see that 3 to 5 times increase in valuation based on their investment. They know that most deals aren't going to do that, and so they broaden their investment over time. And so if you, again, break down the math, they're targeting that 20 to 30% rate of return over their entire portfolio. One of the different strategies that angels will use that VCs don't do as much of is they'll save a large portion of their investment capital for follow-on rounds. And so typically they'll have 10 to 25% that they'll allocate for new investments, but they save the balance for companies that show signs of viability and make it to the next round. Oftentimes investors have participation rights going forward, and so they'll continue to fund the companies that do well and focus less on newer companies. VCs don't do that to a large extent. They typically have reserve capital, but that's not as often such a big part of their strategy. But they also invest in companies that have been de-risked. They typically have friends and family money. They have angel money. They may have gone through an accelerator. And so the risk profile is starkly different. Startups, again, usually give up about 20% each round. It doesn't make sense necessarily for the investor to take more, understanding that down the road the company is going to need to give up additional equity for money in order to grow and realize the returns that investors are targeting. And so they want to make room. They don't want to disincentivize a founder if they get diluted to say 10% or 4% or 1%. They want that entrepreneur to really be focused on exiting the company and providing a return to the entrepreneur and the investors as part of the deal. And so they really want to align those incentives. Valuation is kind of is very tricky early on, and there's not a great model for coming up for one. And really, through Series A, that's largely true. I've had a lot of entrepreneurs try to use the discounted cash flow methodology to come up with a valuation, and it never works. You can't really calculate all of the risk in a deal without just in a startup, especially at the seed stage. Series A are a little bit easier. Startups valuations are always negotiated. It usually comes down to protectable assets, and that can be intellectual property or trade secrets, or first mover advantage, replacement costs, what it would cost to recreate the startup, and other deals being funded. Other deals tend to be a fairly good benchmark. Valuations tend to look the same for companies that are similar, and investors talk. Right? The Salt Lake City Angels, the Park City Angels, all of the VCs talk about the deals they're doing, and they begin to price rounds accordingly. There are a lot of other terms that really impact a deal, much more than valuation. Entrepreneurs really get stuck on that, and it's really not the end-all be-all. Angel investors and VCs often ask for preferred equity, which means different things with each deal. Preferred equity can come along with increased voting rights. That can mean giving up control or even giving up voting non-proportional to equity ownership. Increased liquidation preferences is a big deal. I think good investors will ask for 1 times their money back on liquidation. But early in my career, in the first year of finishing school, we had a deal that we helped fund. We put it together with the Salt Lake City Angels and Park City Angels and had a 1x liquidation preference. And the company ended up raising 5 rounds of capital. But the last round of capital, they gave a 7 times liquidation preference to the last investor, which effectively meant that while the company sold for $75 million, it meant that a good chunk, 80% of the investment that had come in earlier, ended up splitting about $1 million. There's anti-dilution rights, which prevent an investor from being diluted. And there are other things. And so some of those terms can kill opportunities for future rounds. It makes a lot of sense if you go down this route to, one, educate yourself, but have a good network of advisors who can help you understand the things that you don't know that could really end up hurting you. And so to switch gears, let's talk about venturecapital.org a little bit. We were founded in 1983 by Dr. Wayne Brown to further the human experience by technological innovation. And so a good chunk of what we do is helping first-time entrepreneurs and even serial entrepreneurs tell their story to investors. Entrepreneurs typically are very excited about what they do, about what their company does, and they really don't understand the elements of what investors are looking for in terms of understanding the team strength, understanding the market size, understanding the competitive environment. And so we help them through that process. We'll dig into that just a little bit on the next slide. Dr. Wayne Brown died in a plane crash, and we were renamed after him in 1988. We rebranded 2 years ago to venturecapital.org. But some of the things that Dr. Brown and our board has done over time, we architected the framework for the national SBIR and STTR grant programs. Those programs are really big for companies that are solving, really will have any type of intellectual property. The federal government will put out requests for proposals for companies to solve a problem. The National Institute of Health, the Department of Defense, and others, and it's geared to help small businesses develop technology and ultimately to solve a problem. And so an example of that, a company that I'm working at called Teaching It Right, the CEO was a therapist who helped kids with autism develop basic life skills. And she had a theory that she could take her methodology and incorporate it into an app and deliver the content and use her framework to help educators and parents help their kids who are suffering, who have autism, develop basic skills, basic social skills. And so she was able to raise $750,000 from the National Institute of Health to begin to, one, develop the technology and test it with children who have autism, and had great results. And the fantastic thing about that is that investors won't fund that type of development. And so an SBIR program can help companies move forward in that way. Additionally, 2 of our board members founded Utah Ventures, which became UV Ventures and is now Palian Ventures, Utah's first venture fund. All the angel groups in Utah have ties back to our board outside of the Utah Angels 2, Park City Angels, Salt Lake City Angels. We've been very active in that. Over the last 10 years, our companies have closed $1.6 billion, which includes angel capital, venture capital, and private equity, and have helped generate well over $10 billion of returns to their investors. Our program is really designed to be the beginning of the fundraising process. Companies that go through our flagship program raise capital within 12 months, and 80% of our companies over time are still in business either through acquisition or directly. And, we can talk about who some of those companies are. How we deliver it is we have our educational seminar program, which helps entrepreneurs understand issues as it relates to raising capital. And so we had one on safe agreements versus convertible notes last month, which I was a little bit surprised. We had a lot of investors who joined the call. We dug into some of the nuances, the differences, and how it works differently for the entrepreneur as opposed to the investor. We have our mentor program, where as we evaluate companies that fit within our program, those that are approved are matched with a 5 to 8 person mentor team, and they work over a 6 to 12 week period on business strategy and refining their presentation so it is something that an investor would want to hear. That culminates into a variety of pitch events. We have about 10 deal forums throughout the year where we have 4 to 5 companies make a presentation to a panel of 4 to 5 angel and venture investors, and they provide feedback back to the entrepreneur on what they liked, what they didn't, in areas where they think they can improve. And it's really powerful. Most investors are not honest with entrepreneurs that they decide not to move forward with, and they'll give them, there's probably 5 to 10 reasons that they'll give why they're not going to invest, but they are never really truthful. And so providing that opportunity to get feedback, honest feedback from an investor in a safe environment can be really empowering, and it can help build a connection for a future round of financing. We have our We Rock event, which is women entrepreneurs realizing opportunities for capital. It's a day-long conference. Most of it, we focus on content related to women entrepreneurs and the unique challenges they have with raising capital, which is really, really fascinating and helpful to appreciate what some of those differences are. But we culminate it with a pitch event where we have 6 to 8 women-led companies present to a panel of angels and VCs, and they give similar feedback to the deal forum. Our final pitch event is Investor's Choice. We have up to 30 companies that will go through several weeks of mentoring. They have an opportunity to pitch to a panel of VCs in a much more private setting, and ultimately I will present at a conference to 100 to 200 interested parties, which we typically have a lot of angels and VCs who participate. Our last program, which is really fantastic, we've grown it. When I was at Westminster, I finished in 2008 and was hired as an intern for the program. There was only one. We work with 60 to 80 students throughout the year, and our students help us evaluate startups that apply to our programs, interview applicant CEOs to really dig into to see if they fit with our approach. They help us manage our mentor teams for the companies that are being prepared to go through to present at one of our events, and reach out to our alumni to figure out who's been financed, when they got financed, and by whom. And so if anyone's interested in that, you can email me directly or resumes@venturecapital.org. But it's a really fun program, and it's a very unique experience, one that's different than what most others offer. And with that, I'd love to open it up to any questions.
So Peter, thank you very much. Let me actually first give a little bit more of a plug to your internship program. I've known a number of the interns from Westminster that have participated with you, and they find it terribly valuable. But we don't have a lot of interns that come to venturecapital.org from Westminster, do we?
You know, it's really kind of strange. When we started building the intern program, there was a point where I think 80% of our interns came from Westminster, and that was perhaps more of a function of me being an alum. But yeah, now of the 60 to 80, we probably have only 2 or 3 from Westminster. But the experience is very unique. We actually had one of our interns, he was with us for 3 years. He graduated he'd gotten a technical MBA from Westminster, and Michael Keene had referred him into us because he was interested to learn more about private equity and venture capital, which he didn't have much of any knowledge of. But he was with us for 3 years and ended up exiting Intermountain Healthcare and landing in a startup in a senior marketing role. And so yeah, the experience it's very applicable for students who are early in their educational process as well as later, but really to better understand what angel and venture capital are all about.
Well, and quite a few of you that are in the class haven't done your internships yet in your earlier stage. And so I'd highly recommend you explore an opportunity or potential with Peter. So with that, Peter, we've assigned one of our students, Zane, to kind of coordinate the Q&A and act as a discussant here. So Zane, I'm going to turn this over to you.
Okay, thank you. First off, Peter, I just want to say thank you for coming here, and you were very articulate, and quite frankly, you answered a lot of questions that I already had. But one thing I am curious about is how the mentor program would work, and what is the process of that at venturecapital.org?
Yeah, so the way that our process works, we have companies that apply to our program or referred in. We push those out to our interns. We have 4 teams of interns that will evaluate deals. We provide training on what we look for And we look at management as a big item, financial potential, market, the product and service, but we also look for coachability. And so once we kind of identify, we check all the boxes and feel good about a company, we do a call for mentors. Our mentor network is made up of investors, angel and venture investors, who like to work with our program because they can work with startups without the startup really pitching them for capital, right? It's more of a get to know who they are and understand. I would say investors look at coachability probably second only to the team background and bio. But we're a nonprofit. We have a lot of service provider organizations that sponsor our program, so we can offer our services at low cost or free to entrepreneurs. And many of those will participate on teams. So accountants, outsourced CFOs, lawyers, but we have our interns manage those teams. And so at each meeting, we have the CEO give their presentation, and then we go around the room and provide feedback on what we liked, what we didn't, in areas where we think they can improve, and they iterate their presentation based on that. And so part of what we do is very cosmetic in terms of looking at a presentation and saying, I can't read your slides, you have too much text, or your point is, kind of taking me in a different direction. But we also dig deeper, where we'll challenge people on their business model if it doesn't make sense. Typically in a room, we have a wide variety of expertise, which is by design. We try not to put a team together that all have the same background, that all have the same types of experience, so we can provide a real 360 view on 360 feedback to the company so that they don't miss something. Does that help?
Yes, that was very elaborate. Thank you. Is there anybody else with any questions? I know Peter was very articulate.
I have a question. So hi, Peter, and thank you for your presentation. So my question is about people who have a pretty developed idea for business. So what will be your advices for them? Should they go to see, and and if they cannot go have investment by families, should they go see accelerators or angel investors?
It depends on kind of where you're at with the idea. If you have a team, do you have a team put together?
Yep. Yes. Yeah.
How much validation have you done on the idea?
No, so that's not a lot. That's just a developed idea. It's kind of just the beginning. So that's why I'm I wonder what will be your advices to kind of develop the idea and then. Yeah.
So I wouldn't go to angel investors. Tend to be a little bit risk adverse about ideas. They usually, if you have an idea, they'll say thank you, but no thank you, come back when you have a little bit more. But I'd work on validating the idea and finishing out the concept. And so coming back to lean methodology, have you covered lean methodology? Is that part of this course or coursework for the program?
We have not, and it's not one of our concepts, so you're welcome to discuss it some.
So lean methodology is the idea that you fail fast, that you kind of put the framework of your idea together before you go and build anything, and then you go talk to customers to identify what is the value proposition that you're going to be delivering to your segment or segments of customers, and then interviewing real customers who don't know you, who are not friends, not family, that category, because they like you, love you, or invested in you or not, they frequently won't tell you have a terrible idea. And so go out and talk to people who are customers and talk to them about pricing, talk to them about the value proposition, and talk to them about feedback to further improve the idea. And so the idea is when you do that, your idea may be great in 3 or 4 ways, but there may be a fatal flaw, or there may be something that you had never thought of that will dramatically improve what you're going to deliver. And the intent behind that is, prior to the 2000 bust, prior to my time, my second boss coming out of school had worked for a company where they raised like $10 million with a PowerPoint presentation. And that just doesn't happen anymore, right? Companies used to operate in stealth mode. They would spend a ton of money. They'd go to market, and they would have no idea if it was going to be successful or not because they never talked to anyone about it. There's a famous example of the first dog food company that wanted to sell exclusively online, put together their manufacturing, they put together their supply chain, they spent like $50 million in putting together their company, went to market, and dogs wouldn't eat their dog food. Quite literally, they'd ship it out, and they had other issues. They didn't account for shipping, but they had produced a product that dogs didn't want to eat, right, which is a big problem. And so going through and doing your due diligence before you put a lot of money into it can be very helpful for an investor. The other thing that I'd suggest is looking at an accelerator. If you're pretty early, sometimes those can be helpful. They can provide a little bit of capital so you and your team can work on it full-time, not have a full-time job that you're trying to navigate around or school, and can help you iterate your idea to get to where you're going.
Thanks.
Yeah.
Any other questions, guys, before we let Peter go for the day?
Can I ask one more question?
Please.
Yeah. Hi, Peter. Thanks for your time. My name is Paola, and my question is if you're familiar with some of the disadvantages that women face when presenting to venture capitalists.
Mm-hmm. Yeah, so our We Rock conference that we put on, the Women Entrepreneurs Realizing Opportunities for Capital, was really kind of designed around understanding that there are unique challenges that women face. And when we start looking at data, women entrepreneurs or women-led companies tend to provide better returns than men, but attract something like less than 3% of all venture capital. And so we know multi-gender, multi-racial teams perform better. And in my view of the world, when you have a team that all looks the same, that all has the same background, you're not going to see things coming because you all have the same view. And so we've taken that approach with our mentor team. We've taken it in how we kind of build our program. But there are a bunch of funds. There's a Portfolio out of San Francisco, which was kind of a fun VC. It was a group of former VCs that came together that had the idea that investing in diversity can make a lot of sense long-term for returns. And so they crowdsourced a big fund in order to invest. You had to put in at least $11,000. But they focus on multi-gender, multiracial teams. They have an emphasis on women teams. There's a woman, she lives part-time in Park City, Leslie Goldman, which operates the Artemis Fund out of Houston. But they have a $10 million fund, and they're very focused on women-led companies. If you visit our website, venturecapital.org, you can see some of our upcoming events. All of our events right now are virtual. If you email me, I'll send you a discount code. We'd love to have students involved. But we have a lot of our network of investors are like-minded and really like to focus on diversity. Does that answer your question, Paola?
Yes, thank you.
Yeah.
Anything else, guys? Well, Peter, thank you for spending your time with us today. We appreciate it probably more than you realize. Guys, Peter's a good friend of the school, and so let's go ahead and give him a hand. Thanks, Peter.
Thank you.
We'll let
Appreciate
you
you
sign off. We'll let you sign off while we have a little bit more to do together.